A recent AM Best briefing hosted by Sridhar Manyem, head of industry research at AM Best, looked at the current state of the directors and officers insurance market. The briefing began with a look at AM Best's view of the D&O market.
During the first quarter of this year, AM Best updated or maintained its negative outlook on the D&O market, on the professional liability market, excuse me. The D&O market is actually a large part, and so our outlook and our negative outlook is in large part determined by our look and our feeling on the D&O market. And that's largely because the D&O market, from a premium standpoint, is considerable when you compare it to medical professional liability, employer practices liability, errors and omissions, and cyber liability. So our negative outlook on the professional liability market largely is determined by our opinion on the D&O market. And it really is impacted not just by performance-related issues, but also by the overall market challenges that we feel are going to continue to challenge underwriters of D&O insurance and what we see on a going forward basis. So for 2021, we maintained our negative outlook.
I think David got a whole bunch of issues out there in the for us to kind of analyze. So I want to first approach the rate environment. Yuri, I want to bring you into the dialogue. How would you classify this market? Is it a hardening market, or as some observers call it, probably I would say prematurely, a hard market? As we mentioned in our report, the loss ratios, despite several quarters of rate hardening, do not really give us comfort that we are in the real hard market territory yet. So definitely love your thoughts here on the pricing environment.
Yeah, so I appreciate that. Thanks for having me. And I think you can tell very much from David's commentary that there's a lot of nuance in the industry, right? And so, we'll try to cover sort of as much as possible in an hour, but there's corners of the market that are experiencing very different things. On an overall basis, the market remains challenging. If you look at like Aon's pricing report that just came out for Q1, not a single public company client of ours got a decrease on their primary layer of insurance. And that's obviously telling, right? There's a lot of differentiation among clients. There's clients that are in different places in their own microeconomic risk cycle. Their industries are in different places in the macroeconomic risk cycle. But for not a single client to have gotten a decrease on their primary tells you that the market remains challenging, even in the face of some, positive items and attributes like new entrants to the market, a well-performing stock market, what may be a somewhat misleading sort of tally on securities class actions through the first 5 months of the year. In broader scope, the increases have been compounding. I think we're clearly a full 18 months into a difficult market, right? And that's being, I think, light, but if you think of it sort of from last January. And so everyone has now, for the most part, been through one cycle of an increase and are facing secondary renewals where they're looking at increases, and that rate impact is compounding. And for many people, it might be their third sort of run at it. So we're still seeing that. I guess where we are seeing a little bit of light is maybe improving limit factors up the tower as there's more competition on excess insurers.
Interesting. Could we digress from the script a little bit and talk about the MGAs a little bit, right? Because AM Best recently released a request for comment on assessing MGAs. So just your thoughts on what are MGAs doing in the D&O market? Is it more a human capital aspect where they have the expertise, so therefore they take on some of these books and pass it on? What is their role in the D&O market especially?
Yes, it is an interesting phenomenon, right? Because I would think, and Yuri, I'm going to ask him to opine on what I'm about to say, but traditionally, I think, when the brokers were working with their insureds, they would look at it and say, look, you have an MGA here that is willing to put up capital. but you don't know how they're going to behave down the road. They don't own the risk. It's going into the carrier. So I think the brokers are looking at it, and they're looking at what the paper behind it is, and the ability to certainly be there to pay the claims going down the road. When you are in I always say the changing markets are the toughest markets to operate in, meaning going from a soft to firm or a firm to soft. As that transition goes down, you really don't know what to do. And I think what you saw here in the past year was a firming market, a correcting market that needed capacity. Easiest way to get up and running is an MGA on paper and get that capacity out. Now, when you look back, and I mentioned, I think there's about 15, I would say to you probably 4 or 5 of them, or 6 maybe, are MGAs, and the rest of them are, as Yuri mentioned, really what I would call reconstituted capital or strategies going back after the business that they necessarily weren't in.
You can view this briefing in its entirety by logging on to ambest.com. For AM Best TV, I'm John Weber.